Hi everyone, Adrian Player here. In this video, it's the second video in the series on the three different phases in your investment journey. So we've got the ramp phase, we've got the consolidation phase, and we've got the goal phase. Alright, so you've got your three different phases. Now we've already talked about what happens in the three phases. Now we're going to discuss what the banks do and how I'm going to structure things as far as the loans go. Alright, so as far as I'm concerned, my borrowing power is high enough to get me to about 8 to 11 properties depending on the purchase price range. Alright, the majority of my properties will be on interest only for a 5-year period while I go through all the different phases, because mainly I can get close to the principal and interest rates that I'm getting due to the discounts and the loan size. And two, we're in a position where if you're on interest only, you're only making the interest payment on the mortgage, so the rest goes into the offset and you get to control the cash flow. So if you are cash flow positive on the property, you get access to that money straight away, and it acts as a buffer during, obviously all the different sections of the cycle and things, so it's good to have an extra cash buffer there. So the majority of my mortgages are on interest only. They will be for a minimum 5-year period. I am actively fixing a portion of the loans at the moment. I'm lining them up on 2-year fixes because I can get the best available rates. And if I need to do any top-ups because the valuation has gone up, I can do that on the variable portion of the loan without breaking the fix. Alright, so most likely over a 3-year period, every year I'll revalue the portfolio, pull the money out up to 80%, and then use that money for the future purchases. And then once we get to about our 3rd or 4th year, again, pull it out, but then sit it in the offset to use as a cash buffer. So 1, for buying opportunities, and 2, just for liquidity's sake, I'd rather me have the funds than the bank controlling the funds. So yeah, every one of the mortgages at the moment is going to be interest only, except for my Newcastle one, because I set that up on principal and interest on a 20% deposit because it was my first purchase. I did do that intentionally, so I did it on a 20% deposit, mainly because I wanted the ability to draw money out as soon as the value went up, which I've already done once, and I'll do in about 6 months' time. I'll pull out a second lot of maybe 50 to 60 grand in that one as well. Okay, the rest of the portfolio is on interest only, and my future purchases will be on interest only as well. Bear in mind, if you are on interest only on a 5-year period, you are squeezing your principal and interest repayments from a 30-year term to 25 years. So that actually, what it does is it reduces the amount of time you have to make the payments, increases the payments, and then decreases your borrowing power. So just bear that in mind. Alright, but as far as I'm concerned, I will be operating on an interest-only basis. The bank that I'm using at the moment is Commonwealth Bank. The main reason being is that I'm self-employed, so if I've got 2 side-by-side tax returns and the latest year is much higher than the prior year, CBA actually go off the most recent year, so it increases your borrowing power. Now I had this option at Adelaide Bank and ANZ as well, so I had 3 different banks to select on where I wanted to make my purchases. And then what's going to happen is I'll get to about 8 to 10, 11 properties total. Most likely it'll be in year 3 or 4. I'll have the portfolio sitting there, and then I can start doing refinances when I've got 2 side-by-side tax years that are very close to each other. Because once you go to other banks that are not those 3, they'll look at the 2 side-by-side years and figure out if there's a gap in the income. If there is, a lot of the time they'll go off the average of the 2 years or the lower of the 2 years. Alright, so I'm just waiting for my tax returns to get to a stage where we are in a position to refinance, and then that's when I can do some large top-ups up to 80% for the portfolio, but get the interest rates down significantly, and then increase the cash flow while I'm putting on those granny flats. So hopefully this video has helped you in understanding how I'm setting up my mortgages on my investment portfolio, what my total structure will be while I'm in the ramp phase, and then what I'll be doing, after 3, 4, or 5 years when I get into the consolidation phase, what bank I've selected now, when I can potentially refinance, and then what I'm potentially going to do at the time that I can refinance. So hopefully this helps you in a way to understand on structure, how I'm doing things, what I'm going to be doing in the future. I do very much believe in pretty much an open book on how we're doing things, and if this can give you a little bit of guidance, that's great. We'll see you on the next video. All right, then bye.